Okay, let me start. Thanks so much for including my paper. My name is Chao Ying. I'm a finance PhD student from Minnesota. I will be on the job market this year. Today, I will present the pre-FOMC announcement drift and private information. Kaya means microfinance. All comments are highly welcomed. The Federal Open Market Committee meetings have gathered a lot of attention since they announced the monetary policy for economic developments. For example, recently on March 15, Fed cut interest rate to near zero to ease the economic effect of the pandemic. Asset markets respond very strongly after that. Given the huge attention to FOMC announcements, a natural question to ask is, what is the average return around these events? Roca and Munch documents the famous pre-FOMC announcement drift in the equity market that a large excess return is realized in the 24-hour window before FOMC announcements. This figure replicates their results, where the x-axis is the time around the FOMC announcements. The y-axis is the cumulative return on the S&P 500 index. Here is the day before announcement. Here is the day with announcement. Most announcements happen at 2 p.m. or 2:15 p.m. To make sure the pre-announcement drift does not contain any announcement information, I calculate the pre-announcement drift until 2 p.m. Just before announcement, the cumulative return is about 40 basis points. While following the announcement, the return is on average flat. FOMC announcements hold 8 times a year, which implies that 70% of the annual equity premium is realized on these 8 days before announcements. The large magnitude of equity premium earned this period makes it essential for us to understand it. However, it provides a big challenge to the current asset pricing theory because they would predict the premium is earned at or after announcement rather than ahead of the announcement. This is because they think there is uncertainty resolution when the public news comes out. That's why the traditional theory would predict the premium is earned after announcement. Therefore, understanding this important fact can potentially provide new insights into the current asset pricing literature. This paper, I propose and test the private information explanation for the time series pre-FOMC announcement drift. Let me start from some empirical evidence that indicates the presence of private information before announcement. Huang and her co-authors document that the market uncertainty, which is measured by the VIX index, starts to increase 3 days before announcement. And in the 24-hour window before announcement, they find the market uncertainty decreases significantly, which happens at the same window as the pre-announcement drift. We know that the FOMC members are not allowed to discuss the monetary policy in the week before FOMC announcements. They call this as the blackout period. The 24-hour window also belongs to this blackout period. Therefore, the significant and the systematic uncertainty reduction implies that the presence of private information before announcements. Next, to provide more empirical evidence, for each announcement, I can calculate the 24-hour uncertainty reduction. Then I can sort these announcements into tertials. The high group contains the announcements that the uncertainty reduces the most before announcements. The low group contains the announcements that the uncertainty reduces the least or even increases before announcements. After that, I can plot the cumulative return for the high group and the low group separately. In the high group, the pre-announcement drift is deeper, and the cumulative return before announcement is about 100 basis points. While for the low group, there's no positive pre-announcement drift. These figures imply that not all the FOMC announcements are the same. Only the ones that with uncertainty reductions are associated with a positive pre-FOMC announcement drift. Next, I will test the informed trading before announcement to see whether it is consistent with the realized return. The informed trading is not directly observable, so I follow the literature to use the order imbalance to measure the informed trading. The order imbalance is the total difference between the buyer and seller initiated trading volume divided by the aggregate trading volume. And here I applied the take rule to identify the sign of the transaction. The transaction is buyer initiated if the transaction price is higher than the last different price, and it is seller initiated if the transaction price is lower than the last different price. Then I can classify the FOMC announcements into 3 different groups by the uncertainty reduction variable UR. When there is uncertainty reduction in the 24-hour window before announcements and the cumulative return is positive, UR is 1. If the cumulative return is negative, UR is -1. And if there's no uncertainty reduction before announcement, UR is 0. After that, I plot the order imbalances in the 24-hour window for each announcement. As you can see from the figure, when there is uncertainty reduction, the order imbalances are most in the same direction of the realized return and large in the magnitude. While when there's no uncertainty reduction, the order imbalances are pretty small and largely random. Besides, the average order imbalances when there is uncertainty reduction is significantly positive, which is consistent with the positive pre-announcement drift. The significant difference of these 2 groups implies that the presence of informed trading before FOMC announcements when the uncertainty decreases. Here are the potential sources of the private information before FOMC announcements. Wilson-Jacobson and her co-authors provide a history of leaked discussions in the FOMC documents, and they conclude that the Fed policy makers would leak information to drive market expectations. The leakage may also happen accidentally, which has been well studied in the literature of takeovers. Given the huge attention to FOMC announcements, the institutional investors also have strong motivations to collect data related to FOMC news. This also has been supported in the literature. These are all potential sources of private information before FOMC announcements. Given these empirical facts, I would like to account for the time series pre-FOMC announcement drift, as well as informed trading in the presence of private information. Basically, I integrate Chaos model into a standard consumption-based asset pricing framework. There are 3 groups of agents in the economy: the insider, liquidity traders, and competitive market makers. Compared to the standard Chaos model, the main difference is that instead of being risk neutral, the market makers are compensated for the risk of holding assets. The price is set to equal marginal utility weighted payoffs, where the pricing kernel is determined from this standard consumption-based asset pricing framework. And here is the intuition. Let me start from the standard Chaos model so that you can see the difference. The insider has the private information of the announcement, and she trades to maximize her profit, understanding that her trading will affect the price. The market makers can only observe the aggregate order flow from both the insider and the liquidity traders. After that, they will update their belief of the asset value, which will resolve their uncertainty. However, in the Chaos model, when the market makers are risk neutral, there is no additional price impact from this uncertainty resolution. The average return before announcement is 0. And when the market makers are risk compensated, they will update their belief of the asset value and the SDF at the same time, which will also resolve the uncertainty, and it is associated with the realization of equity premium when they are risk compensated. This leads to the upward drift in prices on average. In addition, the market makers would expect on average positive trading volume from the insider to chase this premium. And for the insider, they also have to consider the additional price impact from the uncertainty resolution when she trades. This feedback effect is unique in my model, which generates totally different equilibrium implications compared to the standard Chaos model. My paper makes 4 contributions. First, I provide new empirical evidence that indicates the presence of informed trading in the 24-hour window before announcements. Second, my paper provides a macro foundation of how private information diffuses drives the pre-FOMC announcement drift. The information is endogenously released through insider trading in a standard microstructure framework. We know when there is private information, the price changes. However, that doesn't imply that the average return before announcement is positive. Indeed, if you take the standard kernel model, the average excess return before announcement is literally zero. It is because the market makers are risk neutral. Subro 1991 is the only attempt in the literature that relaxes this assumption by studying one period kernel model with CRA utility market makers. However, even you take his framework, the average return is still zero, since the news is not priced under the CRA utility function. Therefore, my third contribution is that I demonstrate there is a strictly positive pre-FOMC announcement drift if and only if the market makers are risk compensating. The preference of the market makers is very general, as long as the certainty equivalence functional increases in the second order stochastic dominance. And Banxiao 2018 finds that a large class of preferences satisfy this property, such as recursive preference, robust control, and ambiguity aversion. I assume that the consumption does not respond to announcements in this short time interval. This can help me to overcome the challenge that mentioned by Subro, that the kernel model cannot be readily extended to a dynamic framework with risk-averse market makers. My paper also quantitatively accounts for the time series pre-announcement drift and informed trading through the endogenous revision of private information. The equilibrium is captured in closed form, which generates the clear mapping from the model to the data. Here is the literature review. Instead of going to the details, let me start to talk about the model setup. I study an infinite horizon endowment economy that the agents cannot observe the growth rate in the economy. When there is a pre-scheduled pre-FOMC announcement, it will reveal more information of the underlying growth rate, so that the standard asset pricing theory would predict the premium is realized after an announcement when uncertainty becomes smaller out of this public news. This is not consistent with the empirical fact. Therefore, in my paper, I introduced the market microstructure into this consumption-based asset pricing framework. And the main difference is that now the price set to equal to marginal utility weighted payoffs. And here, the SDF is determined from this consumption-based asset pricing framework. This figure summarizes all the essential elements in the model. Next, let me go into the details of the standard consumption-based asset pricing framework. The agents in this economy cannot observe the growth rate MT, but they can update their belief of MT through observing aggregate endowment dynamics. Their posterior belief is summarized by the first two moments, where MT hat is the posterior mean and QT is the posterior variance. Upon the pre-scheduled FOMC announcements, there is additional signal SNT that will reveal more information of the underlying growth rate. This is consistent with the information channel of the announcements in the literature. Here, I assume that all the agents have the recursive preference, but as I said, it can be easily extended to other preferences, such as ambiguity aversion and robust control. I assume that the consumption does not respond to announcements in this short time interval, which helps me get the closed form solution of the announcement SDF. And here, the announcement SDF is countercyclical if and only if the agent prefers early resolution of uncertainty. And it holds when this parameter gamma A is positive. So the main takeaway from this slide is that the standard consumption-based asset pricing framework provides the countercyclical SDF to the market makers. Next, I'm going to introduce the second part of the model, the market microstructure, and define the equilibrium. The market makers observe the aggregate order flow from both the insider and liquidity traders. In the standard Chao model, he will set the price equals expected asset payoff upon announcement. Where when the market makers are risk compensated, they set the price equals marginal utility weighted payoffs. Here, the announcement SDF is determined in the consumption-based asset pricing framework. Therefore, now, after observing the aggregate order flow, they need to update the belief of the expected discounted value and the expected SDF at the same time. This is the main difference compared to the standard Chao model. The insider knows the news earlier so that she has the perfect knowledge of the expected growth rate upon announcement earlier. Following back 1992, I assume that the insider will trade smoothly to maximize her expected terminal profit, which is the price difference times the number of shares traded. She understands that her trading will affect the price so that she will play strategically. Here is the definition of the equilibrium, which is pretty standard, that there is a price process and a trading strategy that satisfy the market maker's break-even condition and maximize the insider's profit. Next, I'm going to talk about the equilibrium implications. Here, as in the literature, I assume the asset value follows a log normal distribution. More specifically, I specify it is a function of the expected growth rate and time t. Here, beta is positive so that the asset value increases in the expected growth rate. In the standard Chao model, when the market makers are risk neutral, the equilibrium price is a linear function of the aggregate order flow, YT. Here, lambda is the famous Chaos lambda, which measures the price impact. And in the benchmark, when the market makers are risk compensated, the price dynamics is a function of the YT head instead of the aggregate order flow YT. I will define YT head later. In addition to that, there is another term, the realized premium appears in these equilibrium prices. This comes from the uncertainty resolution before announcements. There is also another term that appears in the insider's trading strategy. This is because the market makers would expect, on average, the insider trade positively to chase this premium. While in the standard Chao model, when the market makers are risk neutral, there's no additional price impact from this uncertainty resolution. Therefore, the expected insider's order rate in the Chao model is 0, which implies that the aggregate order flow is a Brownian motion under market maker's perspective in the Chao model. However, in my model, I need to define the adjusted order flow that take away the part with the market maker's expectation from the aggregate order flow. And here, YT head is the Brownian motion under market maker's perspective, and it is the new state variable of this equilibrium. Okay, next I will show you the equilibrium implications. And here I use the figure at the beginning to highlight the intuitions of these equilibrium implications. The first is that the equilibrium price is a sub-martingale instead of a martingale, which is expected to increase over time. This is because of the realization of equity premium when there is uncertainty resolution. I find that the slope of the pre-announcement drift is positive, which is determined by the negative covariance of the SDF and the asset value. Therefore, there is a strictly positive pre-announcement drift if and only if the market makers require risk compensation. Second, I find that the expected insider's order rate under market maker's perspective is positive instead of 0 in the standard Chao model. This is because the market makers anticipate the insider trades positively to chase this premium. And the insider has to consider the additional price impact from this uncertainty resolution. So that this feedback effect in the end leads to that the equilibrium expected growth rate, the equilibrium expected order rate from the insider is determined by the premium per unit of time divided by the chaos lambda. Third, the price impact is also a sub-martingale. And here is the intuition that when the market makers are risk compensated, they will benefit from this uncertainty resolution, so that they have the incentive to set the price on average, to set the price impact on average to increase over time, such that the insider will trade and release the information earlier. First, I prove that the equilibrium of the benchmark will converge to the standard KL model as the market makers converge to be risk neutral. This result established the link between my paper and the KL model. Given all these equilibrium implications, my paper provides a micro foundation of how the private information diffuses drives the positive pre-announcement drift. Next, I will show you some quantitative implications from this model. So here, the x-axis is the time before announcement, and NT is the time that the announcement happens. The first figure plots the uncertainty reduction before announcement. As you can see from the figure, the uncertainty reduction pattern is the same for the benchmark and for the KL model. The second figure plots the expected pre-FOMC announcement drift. It is only positive under the benchmark when the market makers are risk compensated. The third figure plots the expected order rate of the insider. In the KL model, on average, the expected order rate from the insider is 0. Where for the benchmark, it is positive. In the end, I plot the realized pre-FOMC announcement drift through simulations. I find that only when the market makers are risk compensated, the pre-announcement drift can match the level of the data. And if you take the KL model, the return is changes around 0. Next, I also plot the distributions of the order imbalances for the benchmark and for the KL model. Here in the benchmark, on average, the order imbalances is significantly positive, which comes from the positive pre-announcement drift, and it is consistent with the data. However, if you take the KL model, the average order imbalance is not significantly different from 0. Therefore, to account for the positive order imbalance before announcement, we also need the risk-compensated market makers. Next, I will introduce the full model to match the time series of the pre-announcement drift. At the beginning, I show you that uncertainty is not always reduced before some FOMC announcements, so that I generalize the benchmark such that the insider may not be better informed, and the market makers have to assess whether the insider has private information or not for each FOMC announcement. And the equilibrium is captured by the following 4 elements: the trading strategy when the insider is better informed, the trading strategy when the insider is not better informed, the equilibrium price, as well as the probability estimation of how likely the insider is informed. I solved this by a nonlinear filtering problem where the dynamics of the probability estimation leads to the nonlinear and stochastic equilibrium price, which helps me to match the time series of the pre-announcement drift. Here are the equilibrium implications upon announcement in this full model. When the insider is better informed, the market makers will figure it out just before announcement, so that the probability estimation is 1 upon announcement. And the asset value and the equilibrium price will converge to the true asset value almost surely, so that all the private information has been combined upon announcement. On average, there is uncertainty reduction, which is associated with a positive pre-announcement drift. Well, when the insider is not better informed, the market makers will also figure that out just before announcement, so that the probability estimation upon announcement is 0. And the asset and the equilibrium price will converge to the initial asset price almost surely, because the insider has no information other than what the market makers know at the beginning when the insider is not informed, so that there is no uncertainty reduction on average, and the excess return upon announcement is 0 when the insider is not better informed. This implies that the pre-FOMC announcement drift only exists if the uncertainty reduces before FOMC announcement. This is consistent with the empirical facts that I showed you at the beginning. Okay, so here is the calibration of the full model. From the empirical evidence, I assume that for half of the announcements, the insider is not better informed. And then I calibrate the initial prior of how likely the insider is informed, and the risk compensation of market makers, the risk exposure of the asset, as well as the transparency of the announcement to match the time series of the pre-announcement drift and uncertainty reduction. Here, to capture the 24-hour price dynamics, I use the E-mini S&P 500 futures to calculate the return before announcement. The VIX is only available in the regular trading hours, so there's no overnight data available. As you can see from the figure, when the market makers are risk compensated, I can match the time series of the pre-announcement drift as well as the uncertainty reduction pretty well. I also plot the distribution of the order imbalances in the model. When the insider is informed, there is uncertainty reduction before the announcement, and the order imbalance is significantly positive. Well, when the insider is not better informed, there's no uncertainty reduction before announcement, and the average order imbalance is not significantly different from 0. This is also consistent with the empirical facts that I document. Next, I will provide more empirical tests to show you that other asset market fluctuations before announcements are also consistent with my model's predictions. First, I want to show you that the pre-announcement drift is consistent with the risk reduction explanation. At the beginning, I already showed you that the pre-announcement drift only exists if uncertainty reduces before announcement. Now, to more formally assess the impact of the uncertainty reduction on the return before announcement, I run the following regression. Here, both the cumulative return and the VIX index and the VIX change is calculated in the 24-hour window before announcement. In the table, it shows that when the VIX decreases 1% before announcement, the pre-announcement drift is about 51 basis points. It implies that the pre-announcement drift is largely explained by the risk reduction explanation. Second, I want to talk about why the pre-announcement drift occurs 24 hours before announcements, when the private information is probably known way before. In the paper, I prove that the insider's expected profit increases in the initial uncertainty. It is pretty intuitive since now the insider has relatively more private information when the market is noisier. Remember that at the beginning I showed that the market uncertainty starts to increase 3 days before announcement, and it peaks around 24 hours before announcement. It implies that to achieve the highest profit, it is optimal for the insider to trade at the highest uncertainty, which is about 24 hours before announcement. So, wait, I'm sorry. So that my paper also explains the timing of the pre-announcement drift. That is one important feature of the pre-announcement puzzle. Third, since April 2011, the Fed starts to introduce the press conference after half of the announcement. And the literature finds that the pre-announcement drift since April 2011 is only limited to the announcements with press conferences. In the paper, I show you that the uncertainty reduction pattern also only happens with announcements with press conferences. When the announcements have no press conferences, on average, there's no uncertainty reduction before announcement, and also there's no pre-announcement drift. Therefore, the two different patterns of the returns since April 2011 are also consistent with my model's predictions. Fourth, Luca and Monge also document there's no pre-announcement drift in the fixed income market. In the model, I found that the sign of the pre-announcement drift depends on whether the asset is risky or hedged. The pre-announcement drift will be negative if the asset's risk exposure beta is negative, means that when the asset is a hedge, there is a negative pre-announcement drift. Campbell and his co-authors found that the nominal bond beta are time invariant, and on average, it is close to 0 during the past 30 years. So when the nominal bond beta is positive, it is risky. On average, the pre-announcement drift is positive. And when the nominal bond beta is negative, and now the bond becomes a hedge, the average pre-announcement drift becomes negative. So unconditionally, it results in the absence of the pre-announcement drift in the fixed income. This prediction also agrees with Sislak and Pang, who finds that the reduction in the common premium is offset by a decline in hedging premium on the bond market around these FOMC announcements. That's why they conclude that the overall bond market response is pretty small. Last, I want to test the informed trading. Here, to measure the abnormal trading activities on announcement days, I also calculate the order imbalances on other days without announcement. And I use two different measures of order imbalance, where OIN is order imbalance of the number of shares, OID is the order imbalance of dollar trading volume. Here, I regress the two different measures of order imbalances on the announcement indicator and also the uncertainty reduction indicator. I find that the coefficient on the uncertainty reduction indicator is significantly positive. So it implies that if there is uncertainty reduction in the 24-hour window before announcement, the abnormal order imbalances are around 2% higher in the direction of the realized return. This is also consistent with my model's prediction. Okay, now let me conclude. I integrate the chaos model into a standard asset pricing framework to account for the time series of pre-announcement drift and informed trading in the presence of private information. I demonstrate that the risk compensation of market makers is necessary and sufficient to account for this pre-announcement drift. The literature also documents other abnormal pre-event drifts and treat that as evidence of the private information. However, they don't have the theory foundation, because if you take the Kyle model, the average excess return is literally 0 before announcement. Therefore, for my paper, it also provides a general framework for other pre-event drifts. And the totally different equilibrium implications compared to the Kyle model provide the new insights into how asymmetric information affects asset prices, volatility, volume, and market liquidity. I leave these interesting directions for future study. That's all. Thank you. I cannot hear you, Chris. I think you mute yourself.
Thanks, Chao, for the presentation. And so we can continue with the discussion by Julio. So
I guess now you can see my screen.
Yes, and now it's full screen. Yeah.
Okay. Thank you for having me. It's a pleasure to discuss this paper. I mean, it touched very close to me, so I really enjoy reading it. It's a nice conference. I also want to congratulate the committee who chose this paper. I think it seems like a very asset pricing paper, and my discussion is going to be to link this paper even more to market microstructure. So I think there's potentially a hidden gem inside the paper. So that's going to be my discussion. So don't be offended, Chao, but I think I'm gonna take out most of the macro and asset pricing out of it. So what's the idea of this paper is that, so he starts with A.M. by Chao, which essentially say that a large fraction of the market premium is realized on macro announcements. And they use that to reject time-separable expected utility. So this is a famous econometric paper. Now the problem is that FOMC meetings have this, this premium realized before the meeting. And then A.M. and Chao show that if actually investors receive some public signal about the information in the meeting, you will have that this market premium is indeed realized before. So since they consume at the announcement and they learn before the announcement, everything holds. And then the motivation of Chao is saying FOMC meetings include a blackout period, so there is no possibility to have a public signal. So what happens when we have a private signal? And now, when you are at this point, you have two options. You can either take A.M. and Chao and prove that with a private signal will also work, or you can use a private signal to show that this private signal indeed generates itself the drift, which is what Chao did. So the question of this paper is not if A.M. and Chao still works with a private signal, is if private information can explain the FOMC pre-announcement drift or not. Okay, so this is not trying to generalize A.M. and Chao as far as I read, but it's actually proposing a new channel through which we can have the pre-announcement drift. And the answer is yes, as long as market makers are risk averse or they are compensated for the risk. So what's the mechanism? I think he did a very nice job explaining it. So we have three agents. We have risk averse market makers. And then for simplicity, we have risk neutral informed agents and noise traders. And now the mechanism is essentially the market maker receives some order flow. She learns from the underflow, and then by learning, uncertainty reduces, and therefore in the next trade, she needs less compensated for the risk, so he increases the price. And that's the whole mechanism in the model, and I think that's very elegant that that's the only mechanism. Now, what's the model itself? So we have two timelines. So we have the consumption timeline and we have the trading timeline. So this is inherited from A.M. and Chao. So we consume every capital T periods. And then in these periods, there are infinitely many identical households which optimize consumption. And there are some aggregate consumption growth to which they face. And therefore, we have an SDF, a stochastic discount factor. Now, the stochastic discount factor, I think, is the only thing we take from the macro finance model. So I'm going to take it in this presentation and just going to keep the stochastic discount factor. And I will talk about the macro finance at the end. I think what is interesting here, at least for this conference and for me, is the Kyle model, which is in between these consumption periods. So he assumes there's a Kyle model in which people trade, and that's very nice because then we have a liquidation date in the Kyle model, which he links very naturally with the actual releasement of the information in the announcement. So I think that's very nice. Also, another problem that I have with Kyle model is it has only one asset. But here we are talking about economy, so it's very nice that you only have one source of risk. The only difference you make with Kyle is the risk aversion, which I think is already doing a lot. So here I arrived to the part in which I put market microstructure that I think is not in the paper, and maybe it should be. So we do have a lot of models with risk-averse market makers. That's what I've seen usually called inventory models, in which the market maker is risk-averse and requires some compensation to hold some inventory. So I think your paper is kind of merging information models and inventory models, although you don't talk much about inventory. So information models, as we all know, they require compensation because of adverse selection, inventory models because of the risk aversion. Now, combining these two models, I found it extremely hard. Okay, there are many moving pieces. I don't know any paper that have done it. So how do you do it? I think the trick is in the pricing equation. So your pricing equation comes from the macro model, and it's just the SDF times the payoff, conditional on the past information and the order flow. So what is not in the pricing equation is the inventory. So all inventory models will have the inventory in the pricing equation, because as the market maker gets most of the asset, so she builds some inventory, then she needs to be more compensated if he wants to buy more, and she doesn't need compensation if she wants to sell, because she already has a lot, so she's happy to sell, because that's hedging. And that's the part that is not in your paper. Now, does it matter or not? I don't know. I don't think it matters much. I think it's elegant, and I'm gonna give you some hints on how to test if this matters or not. But I think you should explain more why you're using this pricing equation instead of the more useful one. And then, of course, another difference is in your model, the SDF depends on the asset, on the value of the asset, while usually in inventory models it doesn't, right? Because here is the macroeconomy, so everything changes, even the SDF. So I think that's good. Now I'm going to give a little bit of example of how an inventory model will work. So in an inventory model, if the market maker has net sales of trillions, right? So he has sold a lot, he has a very negative position on the asset. What he's going to do, usually they have ask and bid prices, so you're going to reduce the ask price to foster people to buy, and therefore you hedge yourself. You reduce your position, so you're actually facing less risk. And you also decrease the bid because you don't want people to keep asking you to sell stuff. You don't want people to keep buying and therefore increase your exposure. So then you're going to have a strong negative deviation from fundamentals. Sorry, that should be negative deviation from fundamentals, because your price is going to be below the actual price. And then it's going to converge back. While in your model, this doesn't happen. What is going to happen is if you sell a lot, prices are going to go down because that's information. So it's going to get closer to the fundamental. And on top of that, the risk premium is going to reduce, so it's going to get even closer to the fundamental. So it's going to get very close to fundamentals. So that's the difference between your model and the inventory models. And that's also the main channel we have to test inventory models. So when we actually test inventory models, we see if prices revert back to fundamentals or prices really stay constant. And now you have the fundamentals because you know what happens at the announcement. So you can check if those revert back or not. And I think that's my main comment, to try to differentiate a little bit and see if your assumption of the SDF, not depending on inventory, really matters. Now, there are also main difference with information models. So this is a difference that I always found interesting when you mix information models with inventory models, so when you put a risk-averse market maker. So in information models, you have the market makers obtain rents from noise traders and then lose the proceeds to informed traders. So that's very neat. Now, when you have risk-averse market makers, the market makers actually earn from the informed agents because there is some risk shifting rents, because the market maker is facing a risk that the informed agent is not facing because he knows. But instead of he knows, you can say he doesn't care. And therefore you have a risk shifting rent. So on top of the adverse selection, you do have risk shifting rents, which are of course welfare improvement. Which means that there might be situations in which noise traders do have positive returns. They get part of the risk premium. I don't know. And also there might be cases in which adverse selection can be optimal for welfare. So you might want to have these informed agents there, because they reshift, they shift some risk from market makers away. So maybe you want to have them. Mendelssohn and Tunka has a nice paper in which there are some situations in which you might have optimal welfare with some insiders in the market. So that's my main comments. And then I also find a lot of disconnection between macrofinance and Kyle. So in macrofinance, you have identical households, while in your Kyle model, you have 3 types of agents. That creates the problem that I don't know really what's the kernel that I need to use to price. I don't know who is providing the liquidity. So it's a little bit, I think it's a little bit disconnected. Also in macrofinance, you have a stochastic aggregate consumption. And in Kyle, you have IID noise traders. Those maybe don't seem like contradicting. But to me, noise traders are those who suddenly receive an income shock or an expense shock, and they need to liquidate their assets, or they just earn some bonuses and they got more assets or something like that, and they trade because of that. in your model, the trading reasons of noise traders is independent of their consumption. There's no actually trading because of their assets. They are just trading somehow in the middle, and then at the end of the mini period, they become everyone becomes equal together. And finally, in the macrofinance model, your consumption growth drift moves continuously, which means that we never know in which state of the economy we are. While in the extended Kyle, insiders know the future consumption growth. Which this means is that in the macro model, nobody, essentially at point T, you only can know. So when the announcement is realized, you know everything. 1 second later, there is only 1 second of uncertainty. But in your kind of model, the actual information range that the inform has is huge because they already know the future. So immediately from the beginning, just after the previous announcement, they already know what is going to happen in the next announcement. Right? And that makes the information range not to increase with T, and therefore it's going to create that. I think that's what creates the sub-martingale of the price impact. So if instead of that, insiders will know the actual growth at time T, I don't know if that price impact based on sub-martingale will work, but still you will have the drift. I think that's very robust. Now, another question that I had when I read this is essentially, do we need the macrofinance model, right? Because if I'm not talking about it, do we need it? Now, I think you do need it. I think it's interesting. I think the title is a little misleading. So I would put like Kyle and macrofinance team in a relay race because they are never together. I think the macrofinance model just gives the SDF to the Kyle. Kyle takes the SDF and then gives the price of the announcement. And then the macro model comes again. But I think it provides nice hypothesis across announcement. And you talk about countercyclicality of the SDF, which I think is very interesting, and all these asset pricing stylized facts that we have. So why not try to see what those facts mean in terms of the drift through the lenses of the Kyle model? So is the steepness of the drift countercyclical, which I think is what you're going to get with a countercyclical SDF. Right? So market makers are really risk averse during crisis, and therefore they really need a high risk premium, so the drift should be much higher. So is this happening or not? I think it will help to test your model. And finally, and this is the question I'm really interested in, is can we go back to time separable expected utility if we have private information, or we need to keep up with the AM Bansal kind of preferences? So I think you did some estimation, which I think you actually calibrated the drift. Maybe it's easier or more convincing to have intraday data, calibrate the Kyle's model, and then see how far away you are from the drift. Because if you can explain the drift just with time separable expected utility, I think that will be great. And then just my last views on the paper. I think it's super inspiring. I think has many empirical facts. So all these things about how the VIX moves, I think is super interesting. They have new mechanisms. So this idea that there's actually a risk shifting mechanism that may order flow positive, I think is very clever. It's super technically challenging. So yeah, so not trivial extension of back, and then you put everything in a macro model. So it's really, really technically challenging, but it's quite easy to read. I think you guys realized from the presentation, it's really well written and it reads very well. So I really recommend people to read it. So that's it. Thank you very much. You are muted, Christian, I think.
Thanks a lot, Julio. I would suggest give Chao the opportunity to respond while I'm waiting for people to raise their hands here. So maybe, Chao, you could, in any way you like, respond to what to parts of the discussion, and then we see if there are additional questions from the audience.
Yeah, sure. Thank you so much for the discussion, and I learned a lot from this. So the first comment is that honestly, I don't know this inventory model. So, like I come from Minnesota and we don't have any people actually work on this microstructure model. So thanks for pointing that out. And after your discussion, I think I kind of understand the mechanism in this inventory models is that their pricing kernel is a function of the inventory. And for me, that my motivation is that I take the pricing kernel from the microfinance. That's why for the SDF, it's only a function of the underlying growth rate. And also, because I focus on these FOMC announcements, so I think it is more natural to say that, okay, the uncertainty about the underlying fundamental is priced in this SDF. Before announcement, the market makers should be more worried about the uncertainty of the fundamental. This is also consistent with the information channel of these FOMC announcements in the monetary policy literature. But I fully agree that I will take a look at these inventory models and see the difference, and also do the test that you suggested to see if that I can, if it is consistent with the data. The second question I want to address is that, so I don't think in my model I need to assume that the insider, she knows all the future information. So it is so for each time. Indeed, for the insider, for each time, she only needs to know this. For each announcement, she only needs to know the growth rate 1 day earlier for each one, instead of all the futures. That's why, like in my model, I also have this extension that the insider may not be informed for some announcement. I agree that on average, for the price is a sub-martingale, but that doesn't require that the insider has to know all the future FOMC announcements. This is the second one. For the third one is that you are talking about whether I can generate the pre-announcement drift with the expected utility. I'm not sure that which framework you are talking about. If you are still thinking that the SDF should be a function of the expected, should be a function of the underlying fundamental, then I don't think the expected utility can generate. Are you thinking that the consumption also responds to this announcement? If that's maybe the CRA utility can generate, but I would say due to the, it's a daily frequency, so the change of consumption should be pretty small in the data. If there is high frequency consumption data, I don't think in a daily frequency, the consumption will change so much so that it will account for this 40 basis announcement premium. That's all the comments I read down. If there's any question I haven't answered, you can ask me again.